Hi everyone. Many of you have heard about the difference of EBIT and EBITDA. This is the basic financial term that we all are aware of and very frequently used in many of the statements. So what is EBIT and EBITDA? Let me explain with the story. So before jumping into the story, let's first talk about what is EBIT and EBITDA. Well, the EBIT itself means the earning before interest and taxes, and whereas EBITDA means earning before interest, taxes, depreciation, and amortization. Now, what is that? Well, suppose there is a pizza company which you own in, and that itself is making $100,000 per month. Expensive for this is $60,000, which is including around electricity bill, gas bill, and the wages and salaries of the workers which are working in that. Well, after removing that, the amount will be we got in hand, that is $40,000. That itself is called EBIT. Now, suppose there are condition in that what there is a host expenses around with that. Host expenses means there is a depreciation of the oven which you are using, so $22,000 every month it is decreasing. As per that, there is a recipe which you like in your name registered with that for the sauce, and that itself per month you are giving $1,000, and the loan is there for the $3,000, and the government is implying the taxes of $5,000, including including all these things, there is a total net profit of $29,000. Well, here comes the EBITDA movement. When there is an investor which comes to your pizza company, he says that he don't care about bank loan and taxes. Then how much is does the juice this company squeeze out on its own? Well, the main thing is if you want to say to the person how much money it is making, main thing is net income, that is $29,000, taxes including $5,000, interest and all these expenses which include all the things, it will be equal to $40,000. This is called EBITDA. Now, what's the difference between EBITDA and EBIT? Well, EBIT itself tells what will be the income before taxes and other things like interest and taxes, but it does not cover the ghost expenses. When EBITDA comes, it covers all the ghost expenses and everything. But the main thing is, if the person is asking for the investment in the company, he will go for EBITDA, not for the EBIT. Now, the another question arises. Imagine you need to buy a second oven that's way more expensive, causing your depreciation to jump from $2,000 to $10,000. So if your pizza sales stay exactly the same, what happened to EBITDA?